Hello everyone, you are watching Saheb Academy. If you like our videos, then please subscribe to our channel and also hit the bell icon for the regular updates, and also follow us on Instagram, Saheb Academy. Now let's go to the video.
Hi everyone, this is the second video of Valuation of Shares chapter, and in the previous video we have seen the concept of valuation of shares and we have seen an overview of all the methods of valuation of shares. Right now in this video what we are going to do is, in this video we are going to solve this problem of valuation of shares with the net assets method. We are going to solve this problem with the net asset method, so we must understand how this method works, what is the formula of this method, and how to calculate the net asset. That is the most important thing in this method, right? So let's understand this method and let's see the formulas and how to calculate the net assets. Fine, let's do that first. Now let's take this example to understand the net asset method of valuation of shares. See here, this net asset method, it is also known as intrinsic value method. Okay, that is also another popular name of this method, intrinsic value method, and there are also lots of other names, right? We have seen that in the previous video. Fine, so now here we are taking this example to understand the net asset method properly, right? So let's say you have a company. Let's say you have a company and you want to value the shares of your company with the net asset method. Fine. So you have to understand the assumption behind this method. In this method, there is an assumption that your company is going to liquidate, your company is going to shut down, your company is going to be closed down. Okay, it is going into liquidation. If your company liquidates today itself, yeah, then what would be the value of your shares? What would be the value that equity shareholders would get? Right, here we are calculating the value of equity shares, right, with the net asset method. So there is an assumption in this method that your company is going to liquidate today itself, and what would be the value of your shares on the liquidation. Fine. So here in liquidation, what we do in liquidation chapter, what we did in liquidation chapter, what we do is we sell off all the assets, right? We sell off all the assets, right? All the assets, right? And whatever money that is realized from selling of the assets, yeah, whatever money that is realized from selling of the assets, we pay off all the liabilities with it, right? From that money we pay off all the liabilities, whether it is creditors, debentures, bills payable, all the liabilities, right? And I'm strictly talking about liabilities, okay? I'm not talking about equity, I'm not talking about reserves and surplus, I'm not talking about share capital, I'm talking about liabilities, creditors, debentures, loans, tax payable, bills payable, outstanding expenses, and what all liabilities are there, all the other liabilities, okay? All the third party liabilities or the outsider liabilities. And when I meant selling of all the asset means, in this chapter we are not selling off all the assets. Here this is not liquidation chapter, here there is just liquidation assumption. So here we have to calculate net asset, right? So this is how we are going to calculate the net asset. We are going to find out the realizable value of the assets. If we sell off the assets now in the market, then how much value will we get, right? That is what we have to find out, and we have to take all the assets, okay? Land and building, plant and machinery, cash, investment, whether the investments are trading or non-trading, you have to take it. And goodwill in the balance sheet also you have to take, patents and trademarks, inventories, furniture, everything, okay? All the assets you have to take, except the fictitious assets. Fictitious assets means like preliminary expenses, yeah, preliminary expenses, then the debit balance in the profit and loss account, discount and issue of shares. These all are the losses and what? And accumulated expenses, right? They are accumulated losses and expenses which have been capitalized in the balance sheet. So fictitious asset will not be taken here, okay? Because fictitious assets will not realize any value to the company, right? There is no value of fictitious assets. So that is why we are not going to consider fictitious assets, and then we are going to take all the assets, goodwill, investment, everything, okay? This is not like goodwill chapter. In goodwill chapter we didn't take goodwill in the balance sheet if there is any, right? And we didn't take non-trading investment, we only took trading investment. But here we are taking everything, because here we are not doing valuation of goodwill, here we are valuing the shares of the company. So what all asset the company has, you have to take that, okay? You have to take the realizable value of that asset, right? This is not liquidation chapter, we are not selling off the assets. I'm just saying that we are going to find out the realizable value of the asset, how much value will the company get, right? And then from that realizable value of assets, we are going to deduct all the liabilities, all the outsider liabilities, okay? All the third party liabilities we are going to deduct from the realizable value of assets. Fine. So after deducting the liabilities from realizable value of assets, if whatever is left, right, whatever is left, that would be called as net assets. That would be called as net assets. But this is not useful to us. Why? Because here we are calculating value of equity shares. Value of equity shares. So we need net assets available only for equity shareholders. Net asset available for only equity shareholders. We need pure net asset for equity shareholders. So in your company, if there is preference shareholders, then whatever claim they have, right, you have to deduct that claim. Whatever claim the preference shareholders have, you have to deduct that. Okay, you have to subtract that from net assets, and then you will arrive at pure net asset available to equity shareholders. Fine. So this is the concept of net asset method. You are going to find out the realizable value of assets, and you are going to take all the assets except fictitious asset. You are going to find out the realizable value. You are going to deduct all the liabilities. Okay, you are going to deduct all the liabilities, but not share capital, not reserves and surplus. Okay, because that is equity, that is not liability. Fine. So all the liabilities you are going to deduct. Okay, and then whatever is left, that will be called as net assets, but you need net asset available to equity shareholders, so you are going to deduct the preference shareholders claim. Fine. So this is how net asset method works, and this is how you are going to calculate the net asset available to equity shareholders, and then you are going to just divide it by the number of shares, divided by the number of equity shares, then immediately you will get the value of shares by the net asset method. Okay, this is the funda and the concept of this method. Fine. So now we are going to see the mathematical formula to calculate the net asset. We are going to put all this into the formula, and we'll see how to calculate the net asset with the proper formula. Okay, so let's do that. Let's see the formula now. Now here is the formula of net asset method. See how simple it is. Here, to calculate the value of equity share, what we do is, first we take net assets available to equity shareholders. First we take the pure net assets available to equity shareholders. We saw, right, how to calculate this? Yes. So we take net assets available to equity shareholders only, and we divide it by number of equity share. We divide it by number of equity share, and then immediately you get the value of equity share under net asset method. Fine. So this is how you calculate the value of equity share with the net asset method, and see how simple it is. It is very simple, right? So now the main thing in this method is calculation of net assets, right? We have seen the calculation of net assets, but let's see proper format to calculate net assets. Fine. So let's see the format. Now let's see the proper format to calculate the net assets available to equity shareholders. To calculate the net assets available to equity shareholders, first what you need to do is, first you need to take all the assets at realizable value. You need to take all the assets, okay? Even goodwill, non-trading investment, patent and trademarks, everything, all the assets, even intangible assets also, okay? Everything you have to take. Except in intangible asset, you don't need to take fictitious assets. I know fictitious assets are intangible assets, but you don't have to take fictitious asset in the total asset. Why is that? Because fictitious asset doesn't have any benefit for the company in future. Due to fictitious asset, there is not going to be any income in future, right? From goodwill, the company will get income, right? In future, there will be benefits of goodwill. But from fictitious asset, nothing will be there. Nothing, because these are accumulated expenses and losses in the balance sheet. If it is given in the question, you just have to ignore it, okay? Should not be included in total asset. You don't have to take it over here. Fine. Fictitious assets are ignored. They do not have any real value that can be realized. So that is why it is ignored. It is not taken over here, okay? Only fictitious assets are not taken. Rest everything is taken. Goodwill, non-trading investment, everything. Fine. So you take total assets, okay, at realizable value, and then you subtract all the liabilities, all the third party liabilities. Fine. After deducting all the liabilities, you will get net assets. You will get net assets. But if in your company there are preference shareholders, and if they have any claim, right, then you have to deduct that also. If there are any dividend that are in arrears, right, outstanding dividends, that needs to be deducted. Fine. And then if there is any proposed dividend of equity shareholders, that also have to be deducted. Okay, we'll discuss about this in the later problems. Fine. Okay, so don't worry, proposed dividend adjustment is very simple. Okay, if they say come dividend value of share, okay, come dividend value, then you don't have to deduct this. If they say X dividend value, then you have to deduct this. Okay, we'll see that while solving the problem in the coming videos. Fine, so don't stress over this, okay? It is very simple. We'll see this in the later problems. And then we have notional calls. Now what are notional calls and why notional calls are being added to the net assets? See, it's very simple to understand. Notional calls are the fake calls. Notional calls are fake or virtual calls that are made to make partly paid up share into fully paid up. To make partly paid up share into fully paid up. But why are we doing it? See, let's understand that. In a company, what will happen is, in a company there will be lots of different classes of shares. Okay, let's say here there are two different classes of shares. One is 20,000 equity shares of rupees 10 each, and another is 30,000 equity shares of rupees 10 each. But here the difference is that these 20,000 equity shares are fully paid up. The equity shareholders have paid the entire amount. But here in these 30,000 equity shares, only rupees 8 has been paid up by the equity shareholders. Fine, by the shareholders only rupees 8 has been paid up. So this is a partly paid up share. Now here, while calculating the value of share under net asset method, here what we need to do is, just for this calculation, we need to make this fully paid up. Okay, and we have to make equal. We have to make it equal to the other classes of shares. So how can we do that? We can make these classes of shares equal by just calling up the unpaid value, by calling up the unpaid amount virtually in books. Here the unpaid amount is 2 rupees. So 2 rupees into 30,000, that is 60,000. So 60,000 will be added. 60,000 will be added to the net assets for this calculation. Okay, so this is what you have to do so that we can easily calculate. Otherwise, it will be a mess. Okay, so easily we can calculate by adding up the notional calls. So we have to add the notional calls. Okay, notional calls are the fake calls that are made to make the different classes of shares equal, to make a partly paid up class of share into fully paid up. Fine, so that is why we add notional calls. Simple, right? Yes, it's very simple. So this is how you do it. You add up the notional calls and then you will get net asset available to equity shareholders. Okay, in this problem itself we are going to see how to do this. Okay, how to add notional calls and how to do this. And then after calculating the value of share, what are we going to do? After calculating the value of share, we are going to reverse this process. Okay, this is a fake adjustment, right? So we need to reverse this. Okay, we need to reverse it and we are going to subtract that value. Okay, we'll see that in solving this problem. Fine, so this is how you calculate the net asset available to equity shareholders, and then you take the formula and calculate the value of equity shareholders, and then at last we are going to reverse this process. Okay, the notional calls will be subtracted. Understood? Okay then. Okay, so this is how you calculate net asset available to equity shareholders. Now let's solve this problem. But before solving this problem, I just want to make it clear. See here, in the question they have given us the balance sheet. They have given us the balance sheet of Jyoti Company Limited, and here the balance sheet is in a vertical format. We are sticking to the vertical format. Okay, here we are sticking to the vertical format. Why is that? Because in some universities exams, right, in BCom exam, what is happening? In some universities they are getting vertical format. The questions are coming in vertical format. The balance sheets are given in question in vertical format, and in some university they are still sticking to the old format, that is the horizontal format. But that's not a problem, right? Horizontal format is very simple. One liability side, one asset side, right? That's so simple. And this vertical format is also simple, but the students, they feel that it is complicated because they are not familiar with the vertical format. So you have to make yourself familiar with the vertical balance sheet. Okay, so now let's solve this problem. So first we'll analyze and then we are going to solve this problem. Okay, so you have to make yourself familiar with the vertical balance sheet. Okay, and it's very simple, believe me. Here there's just some notes to accounts and it'll be in vertical format. The entire thing is same only. Okay, there'll be just some format here. Okay, so let's analyze this problem. Now let's analyze this question very fast. See here they have said the following is the balance sheet of Jyoti Company Limited, right? And here they have given us vertical balance sheet in the question, right? Here we have equity and liabilities, and here we have got assets, right? Yes, and in the beginning they have given us shareholders funds. Note number 1, share capital. Note number 2, reserves and surplus. Yes, so whenever you see note number, right, immediately you have to look for notes and you have to go to notes. Why? Because in notes to accounts you will find the full details. Okay, here it will be just summary and here you will find full details, right? So here as you can see, 10,000 equity shares of rupees 10 each, fully paid up 1 lakh, 20,000 equity shares of rupees 10 each, 7 paid up 1,40,000. So clearly you can see that in this company they have two different classes of equity shares. One is fully paid up and one is 7 paid up, that means it is partly paid up. So when you see this partly paid up class of share, then immediately it should come to your mind that you have to make this class of share fully paid up by way of notional calls. By making notional calls, you have to make this fully paid up. Okay, keep that in mind. And then we have got preference shares. 510% preference shares of rupees 100 each, fully paid 50,000. Now, by just looking at the preference shares also, it should come to your mind that we have to deduct the preference shares entire capital, that is 50,000, and we have to see whether there are any dividend that are in arrears, right? If they have given in adjustment, we have to see. And what is the rate of dividend? Rate of dividend is 10%. This is the rate of dividend, okay? In preference shares, the rate of dividend will be fixed, right? So this is the rate of dividend, 10% on 50,000, that is equal to 5,000. Okay, keep that in mind. And then we have got note number 2, reserves and surplus, debit balance in P&L account. You see reserves and surplus 2, minus 90,000. Oh, why is it in minus 90,000? Why is it minus 90,000? See, that is because it is debit balance. Debit balance means it is fictitious asset. Debit balance in P&L account means it is a fictitious asset. It is a loss, actually, accumulated loss, right? So this is a fictitious asset and it has been shown in the liabilities section, right? In the liabilities section, so that is why it will be shown in minus. It will be shown in the minus figure, right? So it is minus 90,000. And in valuation of shares, we ignore all the fictitious asset. Okay, so we will ignore this. Fine. All right, and then we have got liabilities. See, non-current liabilities, long-term borrowing, secured loans, current liabilities, trade payables, sundry creditors, 80,000 and 30,000. So we have to deduct these liabilities, and these are just categories. Okay, these are just categories. These are the actual items: secured loans and sundry creditors. And the total equity and liabilities is 3,10,000. Fine. And then we have got assets. You see assets, we have first non-current assets. See, tangible fixed asset and non-current investments, land and building, investment. These are categories. These are the actual real items: land and building and investments, 1,50,000 and 30,000. And then we have got current asset. You see, inventories, trade receivables, cash and cash equivalents. All these are categories. These are the real items: stocks, sundry debtors, cash at bank, 40, 70,000, 20,000. Simple, right? And the total asset is 3,10,000. And this is also 3,10,000. Fine. So this is the vertical balance sheet, and then you have to look for any adjustment, whether any adjustments are there in question. Yes, there are some additional information and adjustment in the question. You see here, the current value of land and building is 2,50,000. So you have to look in the balance sheet. What is the value of land and building? See, in the balance sheet they have given land and building as 1,50,000, but in the additional information they are saying 2,50,000. So that means the value of land and building has been appreciated. It has been increased. Okay, and this value will be considered in the valuation of shares. Okay, and that of investment is rupees 20,000. So you have to look investment. Investment is rupees 30,000. So as you can see, the value of investment has been decreased. It has been decreased from 30,000. It has been decreased to 20,000. So there is a decrease of 10,000. Fine. You have to consider this value. And then they have said stock is valued at 50,000. So you have to look for stock. See, stock is of 40,000 in the balance sheet, but here they are saying stock is valued at 50,000. So maybe the stock was undervalued before. It was undervalued before, and now it has been brought to the correct value. Okay, and debtors are expected to realize only 50% of their book value. Here they are saying debtors, sundry debtors are expected to realize how much value? Only 50% of their value. That means the other 50% have gone bad. So we are going to consider only 50% of debtors. Debtors are of 70,000, but we are going to consider in the valuation of shares, we are going to consider only 35,000. That is 50% of 70,000. Okay, all right. So that is what we are going to do. And then the dividend on the preference shares is in arrears for the last 4 years. So here they are saying preference shares dividend is outstanding. It is outstanding for the last 4 years. Okay, so the dividend rate is 10%. So 10% into 50,000, that is equal to 5,000. So dividend for each year is 5,000. Then for 4 years, how much? For 4 years is 5,000 into 4. So that is equal to 20,000. We'll see that. Okay, we'll see the calculation later, right? So here they have given us some adjustments, so we have to adjust the items. Fine. So now let's solve the problem. Okay, so let's do this. Now let's solve this problem. See, here we have the formula. value of equity share is equal to net assets available to equity shareholders divided by number of equity shares. So here we need two things, right? Net assets and number of equity shares. We have number of equity shares. See, 10,000 equity shares and 20,000 equity shares. So that is equal to 30,000 equity shares. So we have got number of equity shares, that is 30,000, right? But we don't have net assets. We have to calculate the net assets, right? So this is how we are going to calculate the net assets. See, first we are going to take total assets, right? But here we have got, see, in the assets we have got land and building as 1,50,000. But in the additional information they have given us that land and building is valued at 2,50,000. The value has been appreciated, so this value will be considered, as I said, right? So 2,50,000 land and building, and then investment in the balance sheet is given as 30,000, but you have to look in the additional info. In the additional information they have given us 20,000, so you have to take this value, okay? 20,000, it has been decreased by 10,000, so that is what I have written over here, okay? 30 minus 10,000, fine. 30,000 minus 10,000, that is equal to 20,000. And then stock, see, we have got stock here. See, this is also asset, right? So stock is 40,000, but in the adjustment they have said it is valued at 50,000, so we have to consider the adjustment value, okay? That is 50,000. And then debtors, see here, in the debtors is of 70,000, but in the adjustment they are saying that 50% of debtors have gone bad. They are saying that debtors are expected to realize only 50%. Only 50% of debtors can be realized. That means the other 50% is bad. It has gone bad and it cannot be realized. So that is why we will consider only the realizable value, that is 50%. So 50% of 70,000, which will be 35,000. Okay, and then they have given us cash at bank, and there is no adjustment of cash at bank, so we'll directly take cash at bank 20,000. Fine. So the total assets worth is 3,75,000. 3,75,000, and then we will go on deducting the liabilities, okay? All the liabilities. We are not deducting shareholder funds, okay? We are not deducting equity, share capital and reserves and surplus. No, we will deduct only the liabilities. Fine. So the liabilities are secured loan and sundry creditors, and there are no adjustment regarding that, okay? No adjustments, so directly we will deduct that, okay? Secured loans and sundry creditors, 80,000 and 30,000. See, secured loan and sundry creditors, 80,000 and 30,000. Fine. 3,75,000 minus 80 minus 30, that is equal to 2,65,000. The net assets are of 2,65,000, but we need net asset available to equity shareholders, right? So we have to exclude the preference shareholders claim, right? We have got preference shares in the company, so we have to exclude the preference shareholders claim, right? So we have to return their entire capital, that is of 50,000. So return that, okay? Deduct that, subtract that preference share capital 50,000, okay? Subtract that, and then in the adjustment it is said that dividend on the preference share is in arrears for the last 4 years, right? The dividend for the last 4 years is outstanding. It has not been paid. The dividend has been accumulated year by year. Now we have to deduct all that, okay? So how are we going to do that? See, 10% is the rate of dividend, the fixed rate of dividend, and the capital is 50,000. So 10% on 50,000 is equal to 5,000, and they are saying it has been in arrears for 4 years. So 5,000 is the dividend of 1 year. Then for 4 years you have to just multiply 5,000 into 4. 5,000 into 4, you will get the dividend arrears for 4 years, that is 20,000. 4 into 5 is 20, right? So 20,000. Arrears of preference dividend will be subtracted, okay? Then we will get 1,95,000. And then we have two different classes of shares, right? Here in this company we have two different classes of shares. One is partly paid up and one is fully paid up. So we have to make them equal. How are we going to do that? We are going to convert this partly paid up shares into fully paid up, okay? Just virtually, okay? This is just fake adjustment. Okay, this is notional call, by way of notional call, and then we will reverse this also. See, how are we going to do this? 7 is paid up, right? So 3 is still pending. The shares are of rupees 10 each. So 3 rupees is still pending. So we are going to make that call of rupees 3, right? 3 rupees call we will make, notional call. So notional call on partly paid up shares, right? 20,000 into 3. Why 20,000? See, 20,000 into 3. 3 is unpaid, right? So 3, okay, 20,000 into 3, that will be 60,000. So 60,000 will be the notional call. Okay, it will be added, and then we will get net assets available for equity shareholders, that is equal to 2,55,000. You understood? It's very simple. First we took total assets, we subtracted the liabilities, right, and then we got net assets, and then we deducted the claims of preference shareholder, the entire capital, and the dividend arrears of preference share dividend. Okay, we deducted that, and then we got the notional call. I mean, we added the notional call on partly paid up shares. Okay, 3 rupees was unpaid, so 3 into the number of shares, that is 20,000, right, in that class of shares only, so that was 60,000. We added that, we got net assets available for equity shareholders. Fine. So now after getting that, what are we going to do? After getting that, we are going to apply the formula, right? We have got that, right? We have got now net asset available to equity shareholders, so we are going to directly apply the formula. So net asset available for equity shareholders divided by number of equity shares, 2,55,000, right? 2,55,000. So 2,55,000 divided by 30,000. Why 30,000? Number of equity shares are 30,000. 10,000 plus 20,000, that is 30,000. So divided by 30,000, we get 8.50 as the 8.50 rupees as the value of fully paid share. But you know that in this company we have one partly paid class of shares, right? So that is why we have to do separate valuation. See here, 8.50 is the value of fully paid share. Okay, 8.50 is the value of fully paid share. Okay, this class of share. But for this class of share, we have made a notional call. So now we have to reverse that. See how are we going to do that? Value of partly paid up share of rupees 7. Rupees 7 is paid, right? Of that class, see how are we going to value? See, first we are going to take the fully paid value. Okay, fully paid value. Okay, which we just calculated. We are going to take that, and then we are going to deduct the notional call which we made. The notional call of rupees 3, right? That we are going to deduct. Okay, the unpaid amount we will deduct minus 3, then we will get the proper correct value of this class of share, proper correct value of partly paid up class of share. Okay, we'll get the correct value, that is 5.50. So how we did this? We subtracted the unpaid amount, the notional call amount, from the fully paid up value. Okay, so that is how you calculate the value of equity share with the net asset method. Okay, you just have to understand calculation of net asset, and then this formula is nothing, and then at last if there is any partly paid class of share, you have to reverse it. You can reverse it just by subtracting the notional call. Okay, just by subtracting the notional call amount. Fine, so that's all you have to do. Okay, simple, right? It's very simple. I know it's very, very simple.